Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and returning on the show with us this week is Jordan Roy-Byrne of the Daily Gold. Jordan, thanks for coming back as always.
Thanks for having me, Colin.
I think it's important to talk about what's been going on the last 5 or 6 days. Gold investors are a little bit worried right now, as they maybe should be. Let's first start with the election night, where you had gold shoot up $60, I believe, in anticipation of Trump winning. And then, the market crashed at the same time. I think it was down 800 or 900 points on the Dow, only to wake up in the morning for gold to be down and the Dow to be up. What do you make of this, Jordan?
Well, I definitely did not expect that to happen. I mean, I have been expecting lower prices in the sector, but not really to this degree, not really to the strong selling that we've seen since that initial pop in gold. I think it's what I see happening with regards to Trump is there's a lot of talk about how tax cuts and this deficit spending, it's going to be inflationary. And I think that's all correct and is bullish for gold eventually. But the problem in the short term right now is the market is so focused on higher interest rates. And we always talk about negative real rates, and they are in place, and they have been driving gold's performance. I mean, historically, they always do. And I mean, they went negative sometime in 2015, and that's driven the strong 2016 that we've had to this point. But I think part of the reason, or if you look at Fed policy and how gold has reacted and where we were coming in the year, there was the expectation that we were going to get 3 or 4 hikes. And of course, we haven't had any hikes. And so that's obviously bullish for precious metals. Now we're seeing the reverse of that, where the market has basically already priced in one hike. The last I checked, right before the Trump victory, the hike was 86% priced in. I haven't seen it recently, but I'd bet it maybe it's over 90% right now. So we know that one hike is already priced in, and so the market going from expecting no hikes. The market going from expecting 3 or 4 hikes to no hikes, it's obviously bullish for gold. But if we go back to the market expecting a couple of hikes, initially that's bearish for gold. And so we have all this the market right now is just so worried about the higher rates being negative for gold. And I think it is initially, but in the big picture, there's many instances where we've had higher rates, the Fed has hiked, and gold has gone up. And that happens when inflation goes up more than interest rates. I mean, that's how you get even more negative real rates. I mean, we saw that examples of this where I believe from about 2004 to 2007, and then also throughout the 70s, where essentially inflation was going up, the Fed was hiking, but they weren't hiking fast enough, and real rates went negative a couple of times. And so, but to take it back to where we are right now, the market is focused on higher rates, which, as I said, is initially bearish for gold and precious metals, but ultimately we're going to see higher inflation, and inflation is going to rise faster than interest rates. I mean, we know that because of the debt situation, we're going to see baby hikes in interest rates, and we're not going to see interest rates rise faster than the rate of inflation. So that's all bullish. But I mean, zooming in back to the short term, I'm just to kind of answer this to finish my long answer. What I'm really looking at is gold against the dollar and gold against government bonds, because gold has been correlated with government bonds for most of this year. And of course, with what's been going on, we've been seeing rates spiking, so bonds going down, and also gold getting hit. So when is gold going to detach from that and start to perform better based on negative real rates and based on the higher inflation and not the lower rates? What that is going to happen after we see a breakout in gold against bonds, and secondarily gold against the dollar. And gold against bonds tried to break out recently but failed, so it's not quite there yet. And gold against the dollar, that's the second thing I'm looking at. And the dollar, I believe yesterday, broke out to a new high. It either did or it's right there. The dollar looks really bullish to me, like it's going to have another big leg higher. And as I said, gold failed to break out against bonds. And if you look at gold's price action right now, it's really in a precarious situation, because if it can't hold above 1,200, if that breaks, I think you're going to see a retest of the low. I hate to say it, but I have to be honest, that's what I see.
Jordan, a retest of the low would mean a double bottom potentially for the price of gold. I could certainly see gold breaking down here. It's just scary how quickly the gold price has dropped and how much. But if we do get a double bottom, what gives you certainty that it will be a double bottom and that gold will not continue going down or stay around $1,000 for quite some time?
Well, I mean, I like your word certainty, because us analysts, some of us always talk like there is certainty, but I mean, there isn't. I mean, we're all estimating, projecting, guessing, so there is no certainty. But as I said, looking at gold, it's been holding above 1,200, but it kind of has a little bit of a rounded top, so the price action is really troubling if it breaks below 1,200. And as I said, and if you look at a weekly or monthly chart, it's pretty clear that a break below 1,200, it could see a big fall from there. Now, with respect to your question, even though rates have been going up, I mean, I'm looking at statistics of real rates, and even though nominal interest rates have been rising, and the Fed will hike, and maybe hike again at some point in the first or second quarter of next year, that's really not changing where negative real rates are. Real interest rates are not. I mean, there's not a big change. There's not a major fundamental change in that relationship, and therefore, I think this sell-off is more. It would be more of a technical sell-off driven by its own weakness, and concurrent with that, you have a breakout in the dollar and perhaps a really strong move up in the dollar. So as I said, I don't see a major fundamental change here with respect to real interest rates, because if you look from 2011 to 2015, I mean, real interest rates increased. Whether you look at the real Fed funds rate or like the real 5-year yield, there was a big change there where they went from, I mean, depending on what you look at, -3 or -4% to 0 or slightly higher. And I just don't see, looking at interest rates right now, I just don't see a major change in the picture for real interest rates. Yeah, they might go up 0.5% or maybe even 1%. I don't see a big enough rise in real interest rates to really change the fundamentally bullish situation for gold. But looking at it the short term here, again, the market is focused on the fact that hikes were put off, and that was really good for gold. So now we're going to see a few hikes. So the market immediately thinks that's bad for gold. That's fine. And secondly, maybe it's the dollar rising and breaking out that pushes gold below 1,200 into this double bottom. And so it's more of a real short-term fundamental development combined with a technical move. I mean, if this case plays out and we do see gold come back down, and I mean, this was just the bear market we had was a historic, really bad bear market. And so you're going to hear people, if this happens, you'll hear people say, oh, we're still back in a bear market. Gold's going to 500, gold's going to 700. I mean, that's total nonsense, because we're going to see huge deficit spending coming. We'll probably see helicopter money in the form of tax rebates or tax cuts. I mean, whatever you want to call it, we're going to see money going into the hands of the people and going into the economy and causing inflation. And we're just going to see small increases in interest rates to go along with that. And that's going to be very bullish for gold. But I mean, obviously, the market's not focused on that right now. My guess is it'll probably start to focus on that early next year or by middle of next year. And I mean, if you look at double bottoms, I mean, this is a common pattern. I mean, it doesn't happen all the time, but the stock market in 1980 to 82 had a double bottom, and then it had a spectacular bull market. Gold made a double bottom from 1999 to 2001, and then it had a spectacular bull market. So if this does play out for gold, I mean, it just makes me even more bullish on the other side. I mean, we would, if this plays out and we do have the double bottom and gold rebounds, after the rebound, you're going to see a very, very strong move that just sustains itself. So that's kind of where I'm at. I'm concerned here over the next couple months, but very, very bullish after that point.
The HUI began the year at about 99 and hit a high of 285. We're now looking at, as of today, 188, 189, so there's been quite a retracement. Now, Jordan, if gold prices do go back to test what you're calling a double bottom, what's your level of confidence that the gold stocks will not go test 99 or even lower on the HUI?
Yeah, that's a good question. I just don't see. I mean, looking at the Huey chart, I think there's support around 130 or 140, so that's something I would look at. If we do get this double bottom in gold, I think we would see a huge amount of positive divergences. I mean, we don't even have enough time to talk about all the positive divergences we would see. And I think first and foremost, we'd probably see that in the gold stocks. I just don't think there are enough sellers to drive them a lot lower. I mean, right now, if you're looking at a weekly chart, for example, I mean, those who follow my work, they know I look at the 400-day moving average and the 80-week moving average. And you can see the 80-week moving average, it was resistance for the gold stocks in summer 2012. They rallied up there and failed. Then it was resistance in summer 2014. Then it was near resistance at the beginning of 2015. Then the market, in this great move we've had this year, rallied way above it. Now the market has come back down and actually tested that, I believe, yesterday. I'm looking at the Huey at a low of 173, exactly where the 80-week moving average is. Tested that. It's had a good rally so far. We might rally for another several days or another week or two, and then from that point, perhaps sell off and lose the 80-week moving average. And like I said, I would look at that around 140. I mean, give or take a little bit. That's probably the next support if we were to lose the 80-week moving average. Now, where we are just one caveat, where we are right now, I mean, all the analogs that I'm looking at, Colin, the gold bull analog has already fallen off course. It's clearly fallen off course. If you look at the miners, they have not gone off course, but they are extremely close to doing so. In other words, if you look at my Huey correction analog chart, the correction has basically gone a little bit off course already. We would need to see a really strong move here to really nullify or negate the bearish potential. I mean, we would need to see the Huey close above. I mean, it's at 189 right now. We'd need to see a weekly close above 220 to really negate the bearish scenario that I'm talking about. And so if you also look at the Huey bull analog chart, I mean, it came down to the point where it has to have a big rally from here and keep going. Otherwise, if this rally fails and it makes a new low, then it's basically off the analog to still be in the original bull move that started in January. So just everything I'm looking at, Colin, says this rally that we have right now, we have to see this rally really continue, sustain itself for a couple weeks, and then for the next month and so on and so forth. And if that doesn't happen, it's going to fail, and then we're going to see this negative scenario play out. And just really, I would call it a pause to the bull market because I don't see anything making a new low. I see gold could test 1080 and maybe 1050 and make a big double bottom, but I don't see the gold stocks. They would just make a higher low at some place, in my opinion. And, you get a lot of talk that, the bull market's over. We're back, we're back in a bear market. I mean, I don't really want to use those terms. It's because they just really, I think they really can cloud what's going on. And in this double bottom scenario, I mean, you just have a retracement of this move in gold. And if we get a successful bottom around 1050, the move off 1050 would be really strong and really powerful. I mean, looking at my historical analogs, you could see gold in 3 or 4 months go from 1050 back to that resistance at 1375. So it will rally back that quickly. I mean, there is potential for that if it forms a double bottom. So even if this breaks down, people have to be really careful to think, oh, everything's over, I'm going to sell. The bear market is back, the bull market's over. We're back in the bear market. We need to sell everything. Gold's done. I mean, that's exactly the wrong kind of thinking to have at that point. I mean, it's a double bottom is the most likely possibility in gold, due to the fact that there isn't a major fundamental change going on here, which I talked about in the last answer. I mean, it's just it would be a technical sell-off, and also driven by a huge breakout in the U.S. dollar. And those things would be temporary, because what I discussed before, the picture for real interest rates, it's not having a fundamental change, and the market would at some point would realize that with Trump's policies, we would see inflation rise quite a bit, and rise faster than yields and interest rates, and therefore real rates would remain negative or even go more negative. I mean, if you look at Jeff Gundlach, he wrote something before the election saying that you could see inflation at 3% by April of next year. And I mean, if that happens, the Fed would probably, they're going to hike in December. Maybe they hike one or two more times after that. But if inflation is 3% and the Fed hikes 2 or 3 times, I mean, you're looking at the Fed funds rate of only 1%, inflation of 3%. That's minus 2% in the real Fed funds rate, which right now is -1 or a little bit less than that. So, I mean, in that scenario, the fundamentals for gold are getting stronger and stronger.
Jordan, let me finish with one last question here, and it's a bit of a silly question after the analysis that you've just given, but what's the chance that gold takes off from here and catches back up to the analog chart, especially the gold stocks, and continues into the bull market? Is your confidence level in that happening just extremely low at this point?
Yeah, in one word, yes, it is. I mean, looking at gold, the daily chart real quickly. I mean, the strength before the election and then the pop. I mean, looking at the chart, you just see a failure of the 50 and 200-day moving average, which are at 1280 and 1290, and so we see a lot of selling there. The 200-day moving average has just gone flat and looks like it's about to trend down, and of course, gold is below that. So we would really need to see. I mean, gold would have to go above that 1280 to 1290 area. You need to see a weekly close above that area to really negate this bearish scenario. I mean, you could see a decent rebound back to 1250, maybe even a little bit above it before the market starts to roll over. And I mean, looking at the Huey, yeah, it's got a good bounce today, but we see the same thing with the 50 and 200-day moving average, where there was a lot of selling there in the first week of November. Major resistance around 220, and the moving averages. The 50 is at 216, the 200 also at 216. We bounced off the 400-day moving average yesterday, which is good, but at 188, 189 right now, you could see a rally up to 200, maybe a tiny bit higher before you start to see some selling. But we'd have to see a weekly close in the Huey above 220 to get the bull market, get the move that started in January back on track. And I see that as a low probability at this point.
Jordan, thank you so much for coming back on the show. For our listeners, go to thedailygold.com. I really recommend the content that Jordan puts out. There's a free list that you can sign up for, and then if you'd like specific trading recommendations or companies that Jordan's interested in, Jordan does have a premium service that I also suggest taking a very close look at. Jordan, thanks for coming back on the show, and we'll have you back here soon.
Thanks for having me, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?